Peace, y'all. Welcome to another episode. We're studying Scout Sniper, ICT Scout Sniper, basically just going over the homework. We're on chapter 1, and we're looking at the price range for the homework that he gave from July 1st to July 5th, basically analyzing price. And if you've been through that first lecture, you'll know that he spoke about higher time frame, the daily, especially the daily and the 4 hour, keying off of those higher time frames to basically take trades in line with the higher time frame trend. So if we look at this day range from July 1st right here to July 5th, you'll see that the day is breaking down, it's trending down. So you have a swing low right here, and as we said before, a swing low is basically a 3 candle pattern. If you count from the left, 1, 2, 3, the lowest candle right here is a swing low. If you count from the left, 1, starting from here, 1, 2, 3, this highest candle right here is a swing high, right? And you go down and you go short. So as this swing low gets broken, that's a market structure shift. We can see that we're in a bearish trend, meaning we're going down. So when these levels pull back up within these bearish areas, we can anticipate, we can drop down to the lower time frame within, and we want these swings to be forming in ICT kill zones, which are like London kill zone and New York kill zone is where we look for trades, right? We don't really look for trades in Asia. We look for trades in London and New York, right? So I'm also going to be adding other stuff that I learned, because I actually, like I said in video 1, I studied Scout Sniper before I studied 90-minute cycles. So, but I'm going to be adding like 90-minute cycles because 90-minute cycles, it allows me to see liquidity on the buy side meaning liquidity at the highs, and liquidity at the sell side's more clearer. It allows me to kind of clearer see the liquidity that lies within sessions. And when you say sessions, like I could be talking about Asia session, London session, New York session. And me personally, I use my sessions are broken down from 6 p.m. to 2:30. That's my Asia session. From 2:30 to 7 a.m. That's 2:30 to 7 a.m. That's my London session. 7 a.m. all the way to 1600, which is 4 p.m. is my New York session, but I break those down. So from 7 a.m., I will go from 7 a.m. to 8:30. That's what I would consider New York 1. And then 8:30 to 10, I will consider that New York 2. And then 10 to 11:30, I will consider that New York 3, right? And then 11:30 to 1, that's like a pause period where I don't trade. And then 1300, which is 1 p.m. to 1430, which is 2:30 p.m. That would be like my New York PM 2. And then 1430 to 1600 would be my PM 3, and I'll close out the day like that. And I'm looking at the highs and lows of all of those sessions, and I'm looking at the liquidity, and I'm trying to manipulate. If I'm bearish, I'm manipulating in the highs of those liquidity. So buys, I would want to manipulate or create a smart money reversal at the highs of those liquidity to then take my trade down. So like for instance, if we're just looking at this chart right here, you can see that we market structure shift right here, and we came down, and this will be daily, and then as this goes up into here, I would be looking to manipulate one of those session highs. This could be in London, New York, right? and I'm looking for a smart money reversal right here in line with this higher time frame bearish order block, PD array, higher time frame, midpoint of that. That's the higher time frame level, key level, and you'll see me break all that down as I'm breaking down, studying Scout Sniper. Like I said before in video 1, I studied Scout Sniper before, and I'm coming back to it just to refine, pull more info out of it to add to my toolbox. So let's keep it going. So this is the daily chart, and as you can see, it's trending down. I'm marking out PD arrays. This is a bearish order block. Up candle, down move, market structure shift right here because it took out this low. I'm anticipating that if price comes back up here, I'm looking for a setup to go down. This is also an OTE trade. If you draw your fib, you'll see it bounce back to premium, and you'll take the trade from up here to go down, because when you're doing OTE, you're going to be looking for a bounce back up into premium of a range. The range from this high right here, swing high, to this low right here. The middle of that is midpoint. Anything above that is premium. You'll be looking for a setup up here. That's how OTE works, right? All right, cool. You can rewind that, slow it down if you ain't catch it too quick. I'm going through because I'm studying also, all right? Play price forward. I'm gonna move it forward right here, and this was me going over, basically going over the chart. And let me pull this back a little bit. Stop. Okay. So basically, I think we had did price, or maybe we didn't, but anyway, I'm looking at price from this level. So as you can see, as price came down here, right? Came down, price came up, price came back down, right? Open, high, close. We closed down here within this rejection block. This is a rejection block, right? Sent price up. The wick of this candle basically is acting as support, right? Even though we're bearish, right, coming down, there is going to be days that has retracement. This open, low, high, close is a retracement day, right? This day retraced back up into premium of this same range, high to low, right? So we're going to be anticipating a trade up here, but for this entire day, it was an up day because it's a retracement. So that's good to know, because even though we're in a bullish trend, there's going to be some days that have retracement, because the market don't just move from high all the way down to low. It's going to be expanding low, retracing high, expanding low, retracing high, and that's the sign of a bearish market. When you're expanding lower and retracing higher, expanding lower, that's the sign of a bearish market, right? So as you can see, there's a high, there's a low, there's a high formed here, and there's a low. So we're going to be looking over this move on the lower time frame, right? So if you look here, this is a 1 hour chart, right? And we're going to fill out the times for this chart, and as you can see, it's forming within this rejection block right here, right down here in the midpoint of that rejection block, and you can see the midpoint of that rejection block on that. And play price forward. This is me highlighting that move, showing that we're going to be making this move up from here to here, and also showing how the move played out. This is a market maker sell model. You have an original consolidation here, you have another accumulation, and then you come up here, you have a small accumulation here, then you have a smart money reversal, which is high, low, higher, high, down. This is a breaker block. Price expands down. This is another concept that you're going to learn as you go through ICT concepts, balanced price range, which basically this imbalance is basically form the same place, then this comes up to rebalance it and then goes off to make it efficient. So you have buy side delivery, sell side delivery, buy side delivery, sell side delivery. That's equal, right? And then you have this imbalance that's left over, and this comes back up to this reprices into it and then takes off, making up here a balanced price range. I mean, that price shouldn't come back up here until this is completed with its task of going down and taking out liquidity here and other places where it needs to take out liquidity. Alright. But this is the market maker sell model, which you have a buy side of the curve first, up into a smart money reversal, which happens here, and then down, coming down. And key levels that sent price up on the left side should send price down on the low side. So you have this order block here, bullish order block that sent this price up. Once price displaces down through it right here, closes under this bullish order block right here, you mark out this bullish order block, extend it to the right, and you'll see that it's acting as support on this side to send price down. All right. So those are things that I learned in other trading. So send price forward, send price forward. And here I'm looking at this level. So this was 11 a.m. on Monday, and I'm looking at how price is reacting at this level right here. So this is 11, which is in New York, and you can see an order block formed right here. Bullish order block on the 1 hour, down candle before up candle. See price comes back into it, and you see price expand up into the next day, which is Tuesday, and Tuesday opens here. So you have open, low into London, and then price starts expanding up. It's working off of that. It's retracing. It's retracing to fill back this level up here, going back to this wick of this daily order block right here. This blue is a daily order block, and not only that, it's going back to key institutional levels that were drawn from these higher time frame PD arrays. PD arrays meaning higher time frame candles, higher time frame PD arrays. You're going to learn about those like rejection block, bullish order block, fair value gaps. All those are premium arrays, because we're looking at, if you look at a range from a high to a low and you have a midpoint, the below the midpoint of a range is discount, above the midpoint is premium. So that's why the term PD arrays form, because algorithmic signatures form in the discount, and algorithmic signatures that we utilize to analyze price also form in premium. And we consider those premium arrays because they form at key levels. We're looking at the one that form at key levels and at key specific times within the sessions that ICT gives. If you're studying this, that's going to be your kill zones. Okay, so this is London. You can see PD array forming here, down candle for up move. That's a bullish order block. Not only that, this is like a mitigation block, high, low, up. This right here, high, low, high, breaker. This is a breaker formed in. This right here is the end of New York, and then this is the open. This is Asia. So you have London, then you go up, and so forth, and we retrace all the way back up into here. I'll get into more details as we go forward. Alright, so this is me marking out those times that this reversal formed. And you can see it started forming from, on the 1 hour, it started forming from 11, went up to 11:30, came back down, did not sweep this low. This is a mitigation block, then came up, swept that high, mitigation. You see this higher high, then if you look at a correlated market, you may see a lower low here, and then the reversal, that's SMT. But price came up, now we're into 2, and the day closed 1600, and now we have a consolidation in Asia, and then this is 12, this is the open. Price open, goes high, then comes back down within this order block or breaker. You could consider this a breaker. High, low, higher high, lower low, higher high. So you could take this entire green candle. Another reason why, because it's a pivotal high, it sent price lower, and then from this low price, it sent price higher. So once price passes through that, when it comes back down, it has to pass through this if it's going to go all the way down. If it's forming a reversal within here, then that's in London, this could be a good opportunity to take a trade up. When you drop down to the lower time frame right here, you'd want to see a reversal pattern forming like this here at this level. Also, it's at a red line right here, which is a higher time frame daily key level within London. For you, studying this would be in London kill zone. You go forward, you could take a trade going up, right? Now, why would you take a trade going up? Because this move, this reversal and this move is coming off of a higher time frame key level. And like we discussed before, in bearish markets, not because it's bearish on the daily means that you won't see higher time frame up move, you won't see up moves play out, because even on a daily chart, price has to retrace to make price efficient. When price comes down and it comes back up, it's balancing out this range, right, to then go back down. As you can see, there's big open liquidity voids here. In fair valuation, ICT called this a liquidity void, or you could consider this a fair value gap. Price has to fill that to make price balance, meaning that all this black candle down, all of this black candle down only offered one side to the market, which was sell side. Green candles has to go in to offer buy side to make this area balance. So that's why price is going up now. That's why price retraces. So as prices retraces on a higher time frame, because it happened, the reversal happened at a higher time frame level, and because you see it playing out here at a higher time frame daily level, institutional level, you can take a trade in London off of that level going up. Click price forward. Okay. So here I expanded the day to show you price coming back up into this bearish order block right here. If you look over to the left side, you'll see my mouse moving right here. This is a bearish order block that sent price up. Now you see price going back up into that level, right? Play. You're going to see me add the times and everything to show you exactly what I'm talking about. Okay. See this line? So we're looking at this right here, which is somewhere around here. This high right here, right? 830, which is in New York, and you can see price came up, swept London high on this day, particular day right here. Swept London high at a key level, swept it and displaced to a key level. Why do you call this a displacement? Well, you see it with a fair value gap going down and candle close even below this short-term low right here on the 30-minute. That's a market structure shift. You can utilize this range from this high to down here, pull it across, and you can enter here to go lower to target this now, this blue area, which is a higher time frame PD array. So from a higher time frame PD array up here to a higher time frame PD array down here, that's a trade which provided itself right here, boom, from 830 all the way down, taking out these lows right here. Play. And I'm gonna annotate all of that. As you can see now, I'm on a 5-minute on this same chart, looking at this same area. All this does when you drop down to a lower time frame and you're keying off of higher time frame levels, higher time frame PD arrays, it offers a way for you to get into trades earlier and reduce risk. So you can see a short-term high right here. As you break that short-term high, price comes back to fill this imbalance. This is your 2022 model. Play. Asia high gets swept, price goes up a little bit more, up into this blue area right here, which is a bearish order block on the daily. Have those levels marked out, right? How do you mark? Where do I get these red lines from? Every swing that forms, you can use every part, meaning the open, the low, the close, and the high of any part of those 3 candles that form on the daily. So I could have a level here, 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 and even the midpoint of those candles. Why? Because if a swing forms on a higher time frame, the levels that come off of that higher time frame swing. When you transpose those levels down to a lower time frame, they will provide significant levels to form trades, key trades off of. They will give you a lot of, like what ICT says, prognostication. Because it's the higher time frame, we key trades off of the higher time frame on the lower time frame. Right? That's what we do. And even in this Scout Sniper tutorial, ICT speaks about making sure all of the trades that you take are forming at a 1 day or a 4 hour level. Sometimes a 1 hour, but he insisted on a 1 day or a 4 hour level. So this is a 1 day level again. All my red lines and the green lines are 4 hour levels. So a reversal patterns forms here after sweeping Asia high. Now, this trade we could take in line with the higher time frame and boom, takes out Asia low and comes all the way back down to this level, which is the wick of this candle right here. That's a higher time frame, like a rejection block. Play price forward. And this is me just filling out times, marking out market structure, looking at how price swept up here. This is New York. You're within New York, 7 a.m. to this was 8. Liquidity that formed here got swept, got purged, went through it, came all the way up. Liquidity formed here, knocked out 2, and then we displaced down with these fair value gaps. This is a displacement and a body close. And we enter the trade right here off of this fair value gap right here. When it comes back up in here, take the trade right here, and we could target lower prices, target this blue area, target the lows here, target the lows here if we wanted to. Alright, that's that. Play price forward. This is me just marking out times. And here, you see me pulling these lines across. Let's go back, J. Stop. Well, right here, you see a fair value gap form, a short-term low form right here. If you drag that fair value across, you'll get a lot of nice areas to pull trades from, right? Because as price displays through this area, when it comes back up, it's going to come back into this level and then continue going down if it has more area to go down. Liquidity down, dollar liquidity low. Keep moving forward. Here we're on a 1 minute looking at the same level right here. Here you could even reduce your risk a little bit more if you wanted to. And you see price break down after sweeping New York liquidity right here, comes up into 850. Boom, short-term low broken right here, fair value gap right here. Fair value gap here, short-term low here. If you draw this across, you'll see that you can get it right here, take the trade. We target all the liquidity that was built up from New York coming all the way down. Here I'm studying SMT between Euro USD and GBP, but down here was Euro USD, so I had to change that to GBP, and here you are. You could see a high form right here, a high form right here, but this forms a higher high and this forms a lower low, then there was a market structure shift. That's a cracking correlation, SMT, smart money technique, from this high to this low, this high to this higher high, this high to this lower high, and then a market structure shift confirms the reversal. Play price. And that's me going through, showing you what I just did. Pull this back. And this is me looking for, this is me at the bottom now. So as we come down into here, this higher time frame, we go into a new day. This is Asia, London, and I'm looking at SMT forming between Euro, USD, and GBP. Look at it on the 1 minute. And that's the SMT being formed between Euro USD and GBP. You can see it forming at around the same time. Close enough. Play price. And this is me just researching and investigating what's going on the 1 minute. 308, that's London. And me looking at SMT forming here when it broke structure. Just researching. And here is this 3 in London, and I'm looking at what happened before. So this is Asia. You can see Asia consolidated as it came into London. The manipulation was down here to 308, right? And then you can see price started going upwards. This is me now looking at OTE. From this low to this high, pull back into here, discount. We capture this swing right here to then take up, targeting the blue area, light blue area up here, which is a daily order block, and any other highs that were formed between there. It's me studying the OTE. Right, so we essentially covered this move from down here to here. We covered this high 850 to this low right here, and possibly tomorrow I'll go over this move up here to down here. All right, cover that move up to, we covered this move down, all right, from here to here off of this level. And then price went back up, and we started to cover this area right here. So that's it for this little run through, and I'm just gonna go through the entire price action, and that's it. It's just practice. Keep it locked. Bang.